2-year point-to-point may be the answer. In this episode, I'm going to address the question how to earn safer, higher returns using a 2-year strategy. Get ready. You're going to be blown away. So my name's Doug Andrew, and I've helped many people optimize their financial assets for now more than 47 years. Also minimize taxes and prepare for a comfortable retirement so they don't outlive their money. And my favorite vehicle for doing that, if you've watched any of my other episodes on this channel, is what I call the Laser Fund. In fact, my 11th book is a 300-page book. I want to gift you a free copy of at the end of this episode, so stay with me here. And it's called the Laser Fund. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. And people say, well, what is a Laser Fund? Well, it's a properly structured, maximum funded, indexed universal life insurance contract. And sometimes people tune out and they go, what? I've never seen an insurance policy perform very well. Well, you haven't seen one structured correctly and funded properly. And frankly, the majority of indexed universal life policies are not structured correctly or funded properly to do what I'm going to show you here, where you can earn average returns like I have, where over, let's say, a 25-year period, I earned 11.17, netting 10.07. A little more than 1% of my rate of return was the cost of the insurance that the IRS said had to be there in order for it to qualify to be tax-free as it grows and tax-free when I take it. But if I'm netting 10%, it means every $1 million will generate $100,000 a year of tax-free income without depleting principal. And there are critics who have never seen an IUL do that because they're looking at the wrong ones. And so they don't think they exist. And sometimes I go, oh, so that's your reasoning? You've never seen one, so you don't think it exists? Have you ever seen your brain before? Well, then how do you know that exists? You know, it's sort of silly sometimes the reasoning I hear. But I can show you all kinds of statements, thousands of them, where clients have earned returns averaging between 7 to 10%. But some years, we've had clients lock in gains of 16%, 25, 26, 61%, 150% by using the strategies I explain on this channel. Now, in this episode, I am talking about a 2-year strategy. And it differs from a 5-year or a 1-year. Most universal life policies that are using indexing, it's a 1-year annual point-to-point. I'll review that quickly. That means, let's say you have $1 million of cash in your policy. It doesn't matter if you have 10,000, 100,000, a million, or 10 million, but $1 million is an easy number to work with. People can extrapolate from it. And many of our clients accumulate $1 million or more by the time they're ready to retire. So let's use $1 million. When you have $1 million sitting in your universal life insurance contract, you can just leave it there and have it earn the general account portfolio rate, which is what the insurance company is earning on their billions and even trillions of dollars in AAA bonds, AA bonds, in mortgages on shopping malls and skyscrapers. They put very little money in the stock market, and so they have an average general account portfolio rate. During the 1980s, I never earned less than 11.75%. I earned as high as 15.5%. On the general account portfolio rate, but that was back when interest rates were high. CDs at banks were paying 10, but inflation was high. Mortgages on homes were 18 to 21%. See, interest rates are relative. So in the last 10, 15 years, we've gone into this 40-year interest rate low. And so interest rates at banks are less than 1%, pretty pathetic. But if truth be known, where is the bank putting some of your money? See, in 2008, when 400 banks went under, 900 more were on the watch list. The federal government asked the 5 major banks to disclose where they have their Tier 1 assets for liquidity and safety. And they had 30 to 40% of their money in BOLI, B-O-L-I, bank-owned life insurance. In a nutshell, they were paying you 1% interest on your money. So every million that they borrowed from the public, OPM, other people's money, when you put your money in the bank, it's in a lended position. They're turning around and putting it into an insurance company to increase the safety, usually by 6 notches higher, AAA is 6 notches higher than many banks who are only rated BBB. And they're increasing the rate of return by 5 times, 500%. They're making 5. Now you say, well, that's only 4% more. No, 5% on $1 million is 50 grand. They're making 50 grand and they're only paying you 10 grand. They're making 5 times what they're paying you. That's 500% more. Okay. Is this beginning to intrigue you? Now, if you're getting interested already, be sure and subscribe to this channel. I have over 500 episodes of education that give you insights into opportunities that maybe you didn't know existed before. Click like, post a comment, but subscribe and click the little bell. And you'll be notified every time I post a new educational video, which I do about 5 days of every single week. But stay with me to the end because I want to gift you a copy of my 300-page best-selling book. You don't need to pay $20 retail. I'll gift it to you, okay? So let's talk about the 2-year strategy on indexing, because most of the time when you link to an index, you're telling the insurance company, okay, link. And let's say it's the 15th of October and they wait until October of the next year. And if the S&P was 1,000 when you linked and a year later it's 1,100, that's a 10% increase. And on your $1 million, they will pay you 10%. That's 100 grand. And people say, well, how can they afford to do that? They know what they're doing. The interest on your $1 million is what you let them use to buy upside options. If you guess wrong and the economy tanks, the options expire worthless, but you didn't lose 1 dime of your $1 million principal. But if the market goes up, you get to participate without the risk if the market goes down. That's indexing. It's not the same thing as index mutual funds. If you have your money in an index mutual fund, you will lose if you have a crash. So that's normally what people use is a 1-year point-to-point. A 2-year point-to-point, very simply, you link, let's say from October or June 15th, it doesn't matter. You link from June 15th and you wait 2 years. If you link in, the year 2020, you wait until the June 15th of 2022. You wait 2 years. So that's maybe a little bit of a downside. You have to wait 2 years to see what you're going to be credited. But what's the advantage of a 2-year strategy? Well, the insurance company, if they have a longer term to calculate the change in the S&P or whatever index you link to, they have a longer term that allows them to save money. They can get options cheaper. And so they are able to pass that on and they're able to raise the cap. So let's say 1-year point-to-point has a cap of 10.5%. On a 2-year strategy, they may say, hey, we'll pay you up to 19%. So if the market went up over 2 years, 19% or more, they're not going to pay you any more if they cap it at 19. But the cap is 19 on 2 years for that 2-year period. And so this oftentimes, over the long haul, it sort of helps you diversify. Now, I may not recommend you put 100% of your money in a 2-year strategy, but maybe 20, 30, or 40%. So on $1 million of cash value, you may want to link 400,000 of it to a 2-year strategy, maybe 40% or 400,000 to a 1-year strategy, and maybe the last 20% to a 5-year strategy. And you can watch an episode on what is different about a 5-year than just a 2-year, because it's not you just wait 5 years and you say, okay, what was the return? They actually average the last year, and you'll learn that in that episode. So what does this mean at the end of the day? What have the average rates of return actually been using a 2-year strategy? So in summary, up till this point, the insurance company, if you use a 2-year point-to-point strategy, because of the longer term, the insurance company can then afford to pay higher caps or maybe higher participation rates. And they can pay you more than 100% of whatever it does, maybe 110%, 130%. So you can participate, and if the S&P goes up 10, they'll pay you maybe 130% of 10, or you'd earn 13 or whatever. But see, the caps are higher because the option costs are less. They're cheaper. So let's look at some of the advantages and actual rates of return using the 2-year strategy, maybe as a part of your portfolio. When you use a 2-year strategy, and let's say the cap is 19%. So the most they're going to pay you is 19% over 24 months. And, you would annualize that, which would be an average of 9.5% a year if you average 19% over 2 years, okay? Keep in mind it's tax-free. So sometimes with a 19% cap, there is absolutely no fee. Other times, there is no cap. So they don't stop you at 19%. There is no cap. They'll pay you whatever it grew to in that 2-year period. And there are some 2-year periods where the gain was tremendous over that 2-year period, especially if you started out in March of 2019 and ended up in March of 2021 and what took place during that time period. You wouldn't have lost money had you been in the 1 year, and it would have linked in 2019 and gone to 2020 when it crashed. So oftentimes you can choose a no cap, and then they will pay a participation, or they will have a threshold or a spread, so they subtract 5% or 10% off of the no cap. So let's say it went up 30%, and we had many clients who experienced 30%. If they charged you 10%, you earn 30 minus the 10, and your net was 20% gain over 24 months. That averages 10% a year, right? So the 2-year strategy may be wise to use or allocate 20%, maybe up to 40% of your money in an indexed universal life insurance policy, just to be able to spread it out and diversify. The key is you want to diversify into superior strategies. Diversification doesn't mean, I'm going to have some of my eggs over in this basket in a bank or credit union earning less than 1% because it has a drive-up window. No, just because they have a drive-up window doesn't mean it's necessarily safe. That's convenience. That's not really liquidity. A bank could hold off giving you your money for up to 6 months if they really had to, if things got in serious trouble in this country. So for liquidity, safety, and predictable rates of return, my choice, bar none, is a maximum funded indexed universal life insurance policy. And a 2-year strategy can be a wise choice to diversify how you earn money, either 1 year point to point, 2-year point to point, or maybe some of your money could be linked to a 5-year strategy. Search that episode on this very channel and you'll see the differences in what I'm talking about. So if this is intriguing you, this is why we wrote the book, The Laser Fund. And it's actually 2 books in one, and it retails for $20. Don't pay that. I will gift you a copy. And it's actually 200 pages of charts, graphs, and explanations on this side. If you learn more by stories, you flip it over. This is 100 pages with 62 actual client stories of how the Laser Fund is used for all kinds of financial goals, not just retirement. But in this left brain side, chapter 6, we address indexing and how it works and the differences between 1 year point to point with a cap, with no cap, a 2-year, a 5-year, multipliers, bonuses. And this book is designed to help you understand how powerful indexing can be for your serious cash, for your future, and why so many people use it as their preferred retirement planning vehicle. I recommend 40 to 60% of your income come from this, and it's not even taxable. The IRS will know you're receiving it, but they don't even audit you because it's been tax-free for over a century as a sacred tax-free cash cow in the Internal Revenue Code. Read and learn why and how you can use this.